Well, we saw the reaction in the FX markets. Let's start with Janet Yellen. She said that the market's asset prices were somewhat rich, a little too frothy, really echoing as well Stanley Fischer's remarks. What was the impact on the markets?
Yeah, so essentially, I mean, what we're seeing here and what people are really talking about is whether there is a concerted effort by central banks to really warn that policy accommodation has probably been too strong and that it can start to be removed. In terms of asset prices, clearly, if valuations are rich at the moment, that has been driven a lot by, obviously, QE over the last few years. And as we all know, with the Fed approaching the normalisation of the balance sheet and the start of that to come at the what we think will be September, you know, this is clearly, I think, part of that whole theme, and I don't think that's a huge surprise to the markets. But certainly equities are a little bit shaky on the back of it, but also I think on the back of fears that maybe the Fed might be potentially about to hike more than the economy can handle at this point.
Or are they trying to kind of react on the front end, basically seeing inflation as being a challenge and trying to communicate to the market that perhaps, be careful with frothiness because eventually rates are going to rise, but perhaps not yet. And so really trying to keep a handle on that, optimism that rates are going to stay low for a while.
Yeah, I think at this stage, I mean, obviously the Fed is leading the charge in many respects. It's clearly, ahead of the game, particularly in terms of the QE program. Obviously, now we're looking at this tapering that's finally happening, and it is about to happen, whereas clearly other central banks are a bit further behind. But certainly, and we'll come to Draghi, I'm sure, from that perspective. But I think at this stage, I found it kind of strange that you would have these hawkish leanings coming from central banks at a time when you're actually getting a string of inflation disappointments, when oil has been falling, if anything, at least over the last few weeks, and also some of the activity data has been disappointing. So it did seem a little bit of a strange time to be, still beating the optimistic drum. But certainly central banks are trying to look through what they think is transitory impact on inflation at the moment, and that things will be down the line, obviously heating up a little bit more, and potentially that will feed through to wages eventually, given obviously you're looking at close to full employment in a number of economies.